Good afternoon, ladies and gentlemen, and welcome to the SERINUS Energy Q1 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and we will send you an email to notify you when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would be as kind to give that your attention, we'd be most grateful. And I'd now like to hand over to Jeffrey Ord, CEO, Andrew Fairclough, CFO, and Calvin Brackman. Good afternoon to you all.
Good afternoon. Thanks, Mark. We're here to run through the results of the first quarter 2021. I'll kick off with a couple of overall comments, then I'll let Andrew run through the results. Starting off, average production for the period was 2,097 barrels a day. I think over the last couple of days, the biggest questions I've had from investors are, is the production in Romania declining? And the answer is yes. I mean, we have a shallow gas field in Romania. Regrettably, like every other shallow gas field in the world, it declines. It declines at about 3% a month. And that is a natural decline. We can put wells in to offset some of that decline. The 1008 well was the last well that we put in. Now we've got a full complement of wells in the field. And what we'll do next on that field is put in compression. And compression will halt that decline and extend the life of the field. I want to be very, very clear here. We do not run this company for short-term production targets. We run it for long-term value. When we drilled the 1008 well, the bottom zone, the deepest zone, the zone we call the A1, was found to be water, which is because Moftino 1008 is over on the edge of the field, and the zone was water. So we closed the sliding sleeve on that 1008 well, and we didn't test from that zone, obviously, because it was water. But while the rig was in the field, we took the voluntary decision to move that rig up to 1007 and close the A1 in 1007. And that means the A1 is now producing from Moftino 1004 and Moftino 1003. And we did that to make sure that we didn't have water break through the 1007 well at some point in the future, because we can adequately produce that zone from the two wells that we're currently producing it from. So we did that to protect all of our well stock and make sure that we produce this field as efficiently as possible, with the goal to produce as much as possible over time, not as much as we can right now. And so people have asked me, you know, why shut it in now? Well, because we had the rig there. And it saves us quite a bit of money to do it now, and not to bring the rig up again a second time when we found that we needed to do it, which we inevitably will in the future. So production in Romania has caused a lot of people some confusion. This is reservoir management for the long term. We could have left that well running, and we could have pushed for the highest production we could in the quarter, and we could have potentially damaged the field and lost that well. So we run this business for the long term. We extract as much value as we can out of our assets, and that's what we've done in Romania. In Tunisia, we had 602 barrels a day of production. That production continues to tick up. We did a bunch of workovers, as most people I think know, towards the end of the year and the start of this year. Those workovers, as we dewater those wells, as we pull on those pumps, and we reduce the water cut, gradually, that production creeps up. The bulk of those increases, in fact, all of those increases in Romania, come from the Schwesh and the Ești fields, where we're 100% working interest in the fields. So 100% of those increases accrue to us. We had average March production of 2,200 barrels a day. So you can see we are continuing to get back on that climbing production. The work we've been doing this quarter to prepare for the Sancrai 1 well, we will drill that well in June. That well is our final commitment well on this exploration phase of the Satu Mare concession license. We'll drill that to 1,600 meters. The target zones are at about 1,000 meters for shallow gas. However, deeper zones for oil exist in this well. It's been very, very wet in Romania. There's been floods in Satu Mare County. Fields are full of water, but we continue to push the surface work. So that's the road and the drilling platform. We continue to push ahead with those. It's slower when you have to push the caterpillars through a lot of mud, but so far they haven't sunk. So we're on track for that June spud. Compression project in Moftino. That was planned for putting compressors in the third quarter. That remains on track. Contractor is constructing. The fabrication is going on. We look to have those the first compressor on a well in the third quarter and accelerating the second compressor. And that's a 2-compressor program. And then the artificial lift program in Cypria. This is possibly the biggest impact that we can have on the company right now is putting pumps into the Cypria field. Those of you who know the Cypria fields will see that on the reserve reports on our website, Gaffney Klein says that there's 445 million barrels of oil initially in place in that field, of which less than 1% has been recovered. And it's a conventional oil field. So again, we're very interested in getting those pumps in. We do have a partner in the Cypria field, ETAP, the government national oil company. ETAP last month had 50 cases of COVID in its offices, so it was forced to shut down its offices. Unlike here in London, working from home is not as efficient in Tunis, and so that has slowed us down. We're not beyond our targets, our schedules, but it is working with a national partner who is suffering from a pandemic in a country that regrettably is not as advanced with vaccinations as we are here in England. And of course, we brought the Moftino 1008 well on production. That well was under budget. That well achieved all the targets we wanted. And that's the last, I think that'll be the last well into the Moftino field. So that's a little bit of a rundown of the first quarter. Andrew, I'll pass it over to you to run through some of the results.
Great, thank you. So here, just a summary of financial highlights. You can see that the group net realized price for the first quarter was $40.16 a barrel of oil equivalent. That translated into realized oil price of just over $54 per barrel and a realized natural gas price across the group of just under $6 per MCF. Revenue for the period was $7.6 million. And operating net back, we're getting back up to just below $24 per BOE. CapEx, we continue to invest in this in our assets, and we spent $3.5 million in the period. Predominantly, that was in Romania, $3 million in Romania relating to the drilling of Moftino 1008 and some of the initial pre-drilling costs for Sankrai 1. Tunisia, $500,000 was spent on workovers relating to Cypria and Shuesh. EBITDA for the period, $2.6 million, and we closed the period with $5.3 million on the balance sheet. So again, we see this as a very consistent first quarter of cash generation and continued investment for growth in the business. We'll cover some of these we've just talked about, but production volume, Jeffrey talked about production in the first quarter. For the quarter, just under 2,100 BOE per day. The uptick there you can see in Tunisia and the natural declines in well management impact in Romania, and closing the exit rate in March was just under 2,200 BOE per day. Realized pricing, again, you can see the impact here, the strength of the Brent price improving in Tunisia, and Romania gas pricing. We're seeing the impact of in the first quarter of the sort of seasonality, the sort of tail end of the colder winter months, and strengthening pricing there. Production expenses, Across the group, for the first quarter, production expense was $11.88 per BOE. That included some one-off mining taxes, which were related to Zinia, which the license expired at the end of last year, and to San Ra, which license expires at the end of this year. Excluding those taxes at a group level, the expense was $10.40 per BOE. In Tunisia, excluding those one-off costs, the OPEX per BOE was just under $21 per BOE. So again, sort of returning to historic levels. Operating netback, again, we're seeing recovery through following the full year results at just below $24 per BOE. CapEx, as I said earlier, we continue to invest $3.5 million, and we have a number of projects coming through for the rest of this year. Funds from operations, $2.4 million. That equated to $2.6 million of EBITDA. Is the same story. Strong cash generation from our assets, including the continued investment into the business. At the P&L level, you can see here revenues $7.6 million, trimmed slightly from the comparative period of last year. Cost of sales decreased rather to $6.9 million. That's a lower windfall tax and a notable decline in the depletion and depreciation charge, with a slight uptick in OPEX, as we've discussed just now, and a slight increase in royalties. That translated into improvement in gross profit of $700,000 to $700,000. That's an increase from just over $300,000 in the comparative period, and the net loss reduced to just over $1 million for the period. Finalizing the financials section, and I've talked about most of these items. Again, it just allows me really to reiterate the consistency and strength of our cash flows. The fact that the balance sheet and the cash flows are much more simplified following the debt retirement. We have none of that EBRD debt burden, and we are very well positioned to continue to invest for the future growth of the business. And with that, I will hand over to Calvin to take us through the next slides.
Okay, thanks, Andrew. I'll talk about our plans going forward for 2021. As you know, we have a large, diverse asset base with over 3,000 square kilometers in the Satu Mare concession, and large oil field with Sabrina at 445 million barrels of original oil in place, as Jeff mentioned. The Sankrai one is the first thing that's coming up, and as Jeff mentioned, it'll be drilled in June, weather permitting, obviously. Pretty excited about that. I'll talk a little bit more about that later. And we also have the installed compression in Q3 that'll stabilize the production on the Montino gas field. We're also planning forward beyond Sankrai, looking at the Madarash area, and we've have some legacy 2D seismic that we've acquired that we're reprocessing that should help us identify some and further refine our prospects. And the artificial lift program in Sabrina is very exciting for the company. First pumps to be installed in a field that's been producing for over 40 years. And 2 of the wells are actually suspended, so we'll be bringing two wells on production that aren't producing anything right now, and then 2 of our current wells as well. And then we continue to do workovers in the Schwesh, Osada, and Eschwesh to increase production. And there's also, in further going beyond that, there's there's a lot of gas potential we've identified in Schwesh, Asada, and Eschwesh. There's a Nawara pipeline that started up from southern Tunisia that has capacity, so we have an ability to start looking for gas and accessing that pipeline for shipment to market. So after a challenging 2020 and getting the recapitalization, we are really looking forward to the extracting value from these projects in our asset portfolio. Sankrai, as you can see, we have estimated gas in place and estimated total recovery. The P50 number is similar to Moftino, and that would be a good result for the company. Our well costs and initial well rates are very positive with what we're looking at. We'll probably try to bring in a single well early development tied into the Moftino gas plant to take advantage of any spare capacity in the plant. And here's the Sankrai 1 drilling status. We've purchased orders of long lead items that have been placed, and we have the installation of the 16-inch conductor pipe coming up in early June, and expect to spud the well in late June. Obviously weather dependent. I'll pass it over to Jeffrey and Andrew.
Yeah, weather dependent. It would have to be very, very bad. That I think the pictures there that Calvin showed you give you an idea of how wet it is. But the bulk of the access road and the platform are finished, so it can rain as hard as it wants. Once we get the road built, it's not going to stop us drilling. So I think it would have to be pretty extreme weather for us not to make our June spud date. So look, I think we had a good, strong quarter. The cash flow is the thing we watch most. I hope that people understand we don't run this for quarterly production. We certainly don't try to maximize a quarter at the cost of the long-term value of the business. So you can always expect in the oil and gas industry fluctuations, and I think that's what we've seen. So with that, I'd happy to take some questions.
Jeffrey, Andrew, Calvin, thank you very much indeed. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, will be available via your Investor Meet Company dashboard. I'd also like to immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Jeffrey, Andrew, Calvin, obviously we received a number of questions ahead of today's event. So perhaps ahead of looking at those questions that are coming in during the event, could I start with these? The first question reads as follows. As there is a large disparity between the UK and Poland listing shares, will you be looking to make them fungible, or are you looking to buy back of the UK listed stock?
The question that always comes up. Yeah, I think today we've got Poland's trading at 6 times the value of London. Let me be clear, the shares are fungible. We only have one share, one ISIN. The issue is that the Polish depository only has a fixed number of shares that we can have in the depository. And so that's 78 million shares. To have more shares in the depository, we'd have to do a full EU prospectus. And the last time we did that, it was over 700 pages long and it cost us $1 million. So we're not doing that. So the shares are technically fungible. Will we do a buyback? Well, we just had our AGM and the company is authorized to buy back shares. But a share buyback is simply an allocation of capital, and we'll allocate capital to the best returns. And right now, we think our projects are the best returns. So we've looked at that, but we have the authorization to do it. But if we did a buyback, obviously we would do it at the London price because that's the price where 93% of our shares trade. It's the most active volume. And it's a price that we think is is the most liquid price. The price is wrong in London; it's far too low. But the price in Poland at 6 times the price of London doesn't really doesn't really reflect the situation either. At one point, Poland had us bigger than Tullow. So, you know, we have a real problem. The company does not believe in dual listings. We don't believe that dual listings add value for us. We don't believe it enhances our asset access to capital. We don't believe it creates a better bid ask for shareholders. Dual listings don't help liquidity. They don't help pricing. And that's just not Poland and London. That's any dual listing. And dual listings come with a cost. It's expensive for us to have two listings. And if we don't see a value in two listings, then we have to recognize that there is a cost to that. So the company is always looking at alternatives, but clearly the dissociation of value doesn't reflect a reality. I think the London price is too low and the Polish price is too high. So a tender for shares, if we did tender for shares, we would do it at a London price.
Thank you very much indeed. The next question received reads as follows: with news of Shell and Eni leaving Tunisia in part due to the social unrest, how do you assess the risk to SERINUS's future profitability in the country?
I think if this question was asked 2 years ago, I would have said it was a high risk. I think in the last 2 years, that risk, the social situation has moderated. We haven't had a strike on any of our fields in 2 years. And so I think that is that's an evolution of a nascent democracy. And I think that people recognize that, you know, going on strike all the time just makes people leave. Saying that, we always invest on a risk-adjusted return. So when we're looking at our investments and the opportunities of investment, and when the business units are competing for capital, we of course have to look at the risks in those areas. And one of the risks in Tunisia that we have to adjust our returns for is the risk of social disruption. And let's be clear, when we say social disruption, it's labor protests and strikes. So yes, we do reflect that in how we allocate our capital. We're looking at allocating more capital into Tunisia than we have in the past. But again, you know, if Tunisia was very, very stable and very, very business friendly, we'd certainly invest more in the country than we are right now. The reason we're holding back is that risk-adjusted return threshold, and we do take a look at those risks. So in the future, there are risks. I think they're much less than they were 2 years ago, and much, much less than when I started 4 years ago. When I first started, we had the Schwesch fields, we had 67 strikes in 1 year. There were so many strikes that we were losing pumps in holes. It was very, very bad. And that situation has ended. But there still is, you know, there still is unemployment, and there still is regional disparities, and those are the catalysts for social unrest.
Thank you very much. The next question, if I may, can you explain the drop in production as a result of shutting in M1007 due to hitting water during drilling of M1008, and what impact has this had on headline reserves?
I think I answered that. So I think there's, if I understood the question correctly, there might have been a mix-up here. 1008 had water. 1007 was still producing from the A1, but we took the prudent step of closing that down before we had water encroach on the well. Aside from production and the decreases associated with production, we have had no impact for reservoir management on our reserves. In fact, if you look at our last reserve report, we increased our proved reserves quite significantly. So the good reservoir management adds value. And so I think I talked about what the effect it had on quarterly production. But again, I need to reiterate, we do not run this business for short-term quarterly production numbers.
And I think the final one is, how would Sankrai gas plant be funded on a success case, and at what cost?
We would fund, if we did build a gas plant there, and there's two scenarios. There's one, run all of the gas up to Moftino and optimize capacity in Moftino, and then two, build a gas plant. As Calvin said, when we talk about Sankrai, we are talking about a cookie cutter of Moftino. It's almost, it's almost exactly the same size. There's no complexities that would be different from Moftino. So if you look at the gas plant in Moftino, it cost us $7.8 million. And so that would be the cost. And we would fund that through operating cash flow. The business is presenting us with operating cash flow that we can allocate to things like that. Now, obviously, if we were building a gas plant, we would take capital. We would slow down other projects to accelerate the near-term prospects of the gas plant. There's not an infinite amount of capital, so we would have to manage that, but that would be funded from operating cash flow.
That's brilliant. Well, thank you very much indeed. Well, that takes care of the pre-submitted questions. If I could ask you just to have a look on the right-hand side and open up the Q&A tab, you'll see there's a number of questions submitted by investors. If I could ask you to read them out, perhaps even who they're from, and I'll pick up from you at the end. Thank you.
Sure. I'm not gonna embarrass people and read who they're from. So, why do you think that the share price doesn't reflect the clear value in the business and the efforts of management? I think up until December, obviously the share price was very affected by the fact that all operating cash flow was being pulled out of the business for debt. We recapitalized and issued a lot of shares. Since December, I think the reason is that there's a lot of movement from the placing. And more recently, our former significant shareholder has exited the business. As they said they were going to do 4 years ago. So we had them leave the business, which I think is, the stock was picked up in the market. I think it was well executed a placing, but of course, 8 point something% of our shares coming into the market do have a holdback effect. So I think that's cleared now. And I think that the stock is very undervalued. I mean, I've never really seen in my career a company that is producing the cash flow that we're producing, that has kind of the valuations numbers that we do. But I also know that our job as management is to sit and run the business as efficiently and as intelligently as possible, and the share price will follow. I mean, value attracts value. It will accrete value. So, I'm not looking at the share price day to day. I'm looking at the business day to day and making sure that our operational decisions and our efficiency is as best as we can make them. Have we considered doing a reverse split? Seems the sheer number of shares in issue is really an issue. No, I don't see number of shares as ever being an issue. It is a liquidity benefit, and no, we haven't considered paying lawyers and brokers to execute something that we don't need. What do you expect going forward, Romanian gas realizations as a percentage of TTF? Well, I once was at an OPEC meeting where the Secretary General of OPEC told the research analysts in the room that he couldn't predict the oil price, so why were the analysts bothering? We don't try to predict the oil price or predict commodity prices. What we do is look at historically what Romanian gas realizations have been in TTF, and that gives us a guide to, given the supply-demand fundamentals, what they might be in the future. Now, I just said we don't predict, but we do try to have a view. And historically, the differential, Romanian gas is traded at a premium to TTF of about 25%. Now, with increasing domestic demand and with no new pipelines coming into Romania, we would expect those type of premiums to continue. So, I can't predict what TTF is going to be affected by big LNG cargoes coming in. I can't really predict what Romanian gas prices are going to be, but I do know that nothing has changed, and historically we've tended to see about a 25% premium of Romanian gas over TTF. What is the approximate cost of the compression project in Romania? It's about $600,000. About $600,000, a little bit more. Yeah, it's a 2-well compression program, so it's not expensive. Could you tell us more information about plans for Q3 and Q4 in Tunisia? Tunisia is all about working the fields. So we're looking at whether it's Q3 or Q4. We're now looking at doing a workover in EC1, which is the Eshwesh well that's producing. Now that well produces a variable. It can be 40 barrels a day. It can be 200 barrels a day because it's got a 22-kilometer long flow line. And so pressures are not enough, so it kind of burps. So we're looking at possibly doing a workover there to see if we can make that produce more smoothly. And of course, Q3 and Q4, these are when we would really like to start getting pumps in. Now, if you look at our corporate presentation, you'll notice that we say that we're starting the artificial lift program. I think it says we're starting in May. We started in May. We're working on that. We're getting everything in order. I want to be clear. That doesn't mean we put the first pump in May. That's a whole project. And when we put those pumps in is a function of tendering for rigs to do the work for us, finding the best value. If you have to wait a month to get a cheaper rig or a better rig, well, that's the kind of decisions we're perfectly comfortable making. This again, it's a long-term value, so we're not rushing it. But in Q3 and Q4. We should be able to get the first pumps and have some results out of the W1 well in Sabria, and that I think is going to be the really big one. This is a good question. Has there been any progress in industry efforts to make the Romanian windfall tax less punitive? Well, unfortunately, it's not an industry effort because the windfall tax is punitive to people who have yet to recover their capital of their investment. And so the tax was actually targeted at OMV Petrom and Romgas. And they've had these long legacy projects. They've recovered their investment, and it is truly a windfall tax for them. What the tax does is it really disincentivizes new projects. And those of us who've been around for a while know that tax came in just before we started Moftino production. Now, we have had talks with the energy minister, secretaries of state. Our head of our Tunisian business unit is hoping to see the prime minister this week. So we are having lots of conversations. I think the important thing is to get voices in our corner to say that this tax needs to, at a minimum, allow us to recover our capital before determining that we've had a windfall. And so, yes, there's been progress. It's been slow. I think tax risk is a global problem. And I think we will see tax risk across all industries. Governments have spent a lot during the pandemic. Governments will look to, recover some of that through tax revenue. And I think there'll be pressures on taxes all over the place. But I hope and I think that we will get some relief on the windfall tax in Romania. Is the company in a closed period? No, the company came out of the closed period when we announced our results. Is the board of directors likely to increase their investments? I don't speak for individual directors. They are able to increase their investments if they'd like to at any time, as long as we're not in a closed period. Okay. How likely do we feel that SERINUS will be awarded OABS's 40% share of Satu Mare after the default of tax fee? Okay, let's be clear that we have that 40%. It's not getting awarded to us. It's not getting. We paid for 100% of Moftino. We receive 100% of the revenue from Moftino. We run Moftino and we run the Satu Mare concession. OABS, Rompetrol, was defaulted out. They did not remedy the default. They did not action the default. We would like the Romanian government to gazette that title, so formally write that title in the books in Romania. It doesn't affect how we operate. It doesn't affect how we work. But in Romania, to do that, you have to have a mandate from both board of directors saying that they agree to transfer the interest. So OEBS has refused to pay their share, refused to do anything except obstruct. So we have taken that to arbitration. So let me be clear. We have the 40%. Do I think that the arbitration will, what we're looking for is an order to tell the Romanians to transfer that formally on the books. And yes, I do believe that OEBS has not, not abided by the joint operating agreement, not paid their cash calls, not participated, they don't have insurance for anything. So, they just haven't done anything that would be a partner would do. So no, it seems it would be very, very odd if we wouldn't. It's a procedural step that we're having to go through. Why do directors not hold a decent amount of shares? I don't speak for individual directors. Every time that Mrs. Auld allows me to buy shares, I buy shares. I have options, but why haven't I exercised them? I haven't exercised them because I don't think that this is a good value point to exercise them at. I would not exercise options, nor would I sell shares at this price. My expectation for the price is much, much higher than what it is here. And so, yes, I'll hold my options until we get to those much higher prices. Would the company be interested in a potential takeover? I'm not sure if you're suggesting we would take over someone or someone would take over us, so I'll answer both sides. Yes, we always look at ways to grow the company both organically and inorganically. And are there other businesses out there that we think that we could acquire and do a good job with? Yes, there are. So if you're asking me if we would ever look to buy another company, the answer is dependent on value and dependent on what we saw as being how we would create value, then yes, we would consider that. Are you asking me if we would sell this company if someone came along and made a proposal for it? I was once famously quoted in the Wall Street Journal as telling the Wall Street Journal that my grandmother was for sale. Everything is for sale, but as I said with my options, we think the value is much higher than what it is now, and we would defend for that value. So yes, everything's for sale, and ultimately, whether we sold the company, that's a decision for shareholders, because we would take that to shareholders if there was a proposal that the board thought was sufficient. What is the anticipated barrel of oil increase for 2021? I'm not sure if you're asking for production guidance, because I think we've been fairly clear that we don't give production guidance. We've talked about, when we raised money back in December, we've talked about 2,500 barrel a day average for the year. I think that is still a reasonable target for us. So we don't give production guidance simply because we take decisions that sometimes will defer production for better value in the future. It's not all about production, it's about the long-term value of our assets and extracting as much value as we can for shareholders. And the 2021 forecasted capital program?
About $11.5 million.
$11.5 million.
Jeffrey, Andrew, Calvin, thank you very much indeed. I think you've been very generous with your time. I think you've addressed most, if not all, of those questions that have come through from investors, and thank you to all the investors that have submitted those questions as well. Perhaps, Jeffrey, before I divert investors to provide you with feedback, I could ask you for a few closing comments, and then as I say, I'll close the session and redirect investors.
Yeah, just in closing, firstly, thank you everyone for listening to us. We're trying to make these as informative as possible. We believe in quarterly reporting. We believe it gives our shareholders information on a more timely basis. We are going to continue to be a quarterly reporter. And so we look forward to doing these in the future, and I hope that people are comfortable asking us questions. Where we can, we'll always try to answer your questions. So thank you.
Jeffrey, Andrew, Calvin, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you'd be so kind, it'll only take a few moments, and I'm sure is greatly valued by the company. On behalf of the management team of SERINUS Energy, I'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.